Objectives. At the end of the lecture, you will be able to describe the differences between cross-sectional and time series analysis, illustrate the usefulness of the ratios, explain the 4 categories of financial ratios, calculate and interpret selected ratios. Lecture outline. We will touch on 2 categories financial ratio for this lecture: leverage ratio and profitability ratios. Leverage ratio. Leverage ratios measures the firm's debt relative to equity, the degree of indebtedness. This will be covered by the debt ratios. Its ability to cover interest expense during earning. Its ability to service debt obligation. In short, pay interest expense. It will be covered by times interest earned ratio. The debt ratios measures the proportions of total assets financed by the firm's creditors. The formula is this: debt ratio equals to total liabilities divided by total asset times 100%. Times interest earned ratio. The ratio measures the number of times that earning before interest and tax covers the firm interest expense. It measures the firm's ability to make contractual interest payment. In short, it measures the ability of the firm pay interest expense. The formula is this: interest times interest earned equals to earning before interest and taxes divided by interest expense. Do take note, EBIT is equals to operating profit. Usefulness. Comparing the ratio with the industry average will give an indication of whether the firm has earned sufficient profit to service interest expense on debts. So in short, it basically see whether is there enough profit to cover the interest expense. This is an important ratio to be looked at by investors and bankers. Profitabilities ratio. This is an important ratio where many parties are interested in: investors, bankers, and even management. Investors are generally interested in 2 aspects of a firm's financial performance. Take note, this is a performance, how well they are doing compared from year to year. Both relate to a firm's ability to generate profits efficiently and generate increasing value of its shares to shareholders. These are 2 very important figures, and shareholders are very interested to look at. Both aspects relates to the firm's profitability, to the firm's profitability, and the ratios that measures this can be separated into 2 main groups. There are 2 main groups from here. First group is margin ratios. Basically indicates the profitability in relation to sales. They take reference from sales and how much profits they can make from it, how efficient they are. First one is gross profit margin. Next is net profit margin. For the other group, 2 is return on investment ratio. This indicates profitability in relation to the level of investment. So there are 2 differences. One is in relation to sales. The other one is in relation to investments. The ratio is covered on is return on assets, in short ROA, also known as return on investment, ROI. Gross profit margin equals to gross profit divided by sales times 100%. It indicates the percentage of each sales dollars remaining after the company has paid for its goods. So basically, in short, gross profit is derived after sales, is basically sales minus cost of goods sold. Okay. This enables us to judge how successful an entity has been in trading. Net profit margin equals to net profit after tax divided by sales times 100%. It measures the percentage of each sales dollar remaining after all costs and expenses. So basically, after minusing all the costs and expenses, including interest and tax that have been deducted. So it measures the X dollar of net profit made through each sales dollar. Return on assets, ROA, equals to net profit after tax divided by total assets times 100%. It measures the overall effectiveness of the firms in generating profits with its available total assets.